I am so stoked with my guest, having this guest on today. His name is Toby Carlisle. I know a lot from the audience already knows who he is, but for those of you who doesn't know him, Toby is the best-selling author of Deep Value and Quantitative Value, two great books. I can definitely testify to that. He is a corporate advisory lawyer. He is specializing in mergers and acquisition, and he's also the founder of Acquires Multiple. So, Toby, did I leave anything out?
That's a great introduction. Thanks, Stig.
Thank you so much. So, a lot of people, if they don't know you, they will probably be sitting out there thinking, so Stig, you're saying that Toby is the founder of Acquires Multiple. That made no sense at all. So I don't know if we can just start off the interview by you introducing what is Acquires Multiple and why is it important for me as an investor.
The Acquires Multiple is a tool that you can use to identify undervalued stocks, and the particular qualities that the Acquires Multiple looks for is kind of a cashed up balance sheet and strong operating earnings in relation to the portion of the business that you're actually paying for. So the acquiresmultiple.com is a website where I have a screener or a series of screeners that identify stocks that adhere to the model that we built in quantitative value, and then I extended in deep value. So basically it's looking for the kind of positions that leverage buyout firms, private equity firms, and activists look for. So it's not necessarily a great business. It's just a company that's undervalued, and it's got some cash on its balance sheet and some operating earnings. And when we test that, it's worked very well at identifying companies that tend to outperform over the next 12 months.
So how much are we talking about when you're talking about outperformance? Is it a lot?
It varies. One of the nice things about the Acquires Multiple is that it works in undervalued. It works in small capitalization stocks and it works in large capitalization stocks. It's a statistically significant outperformance. So it seems to be genuine. It's one thing that academia have sort of found in the last 10 years or so. It's been called the enterprise multiple. It has a few different variations, but it's basically operating income or earnings before interest and taxes, or earnings before interest, taxes, depreciation and amortization, scaled against the enterprise multiple, which is market capitalization, taking out the debt, and then adding back in any other liabilities. So, taking out the cash and then adding back in any of the liabilities like debt or underfunded pensions, off-balance sheet liabilities like operating leases, so on.
Mm-hmm. So would it be wrong for me to say that it's sort of like price to earnings, but you are engineering the multiple, like on both sides, both the price and the earnings?
It's the same idea. It's it's a simple ratio, but it's a more powerful ratio because on the earnings side, earnings is kind of the last thing on the income statement, and there's a lot of manipulation that can occur between the top line and the bottom line. So the top line sales, and then you take out of that the cost of goods sold to arrive at operating income. And on the other side is market capitalization, which doesn't tell you how much debt the company's carrying or how much cash it has. So a company could have quite a high price earnings multiple and yet be undervalued. And so even though if we test the price earnings multiple, it's very good at identifying undervalued companies too. It's just that the enterprise multiple is better because it sort of penetrates the statements a little more.
Yeah, because that was one of the things that really spoke to me whenever I was reading Deep Value, was that you show that actually just price to earnings, which I guess like all investors know, that actually outperform the markets too. But then you have the thing called Acquires Multiple, which is basically an even better metric of performance.
Any of those fundamental measures are reasonably good at identifying undervalued stocks. It doesn't really matter whether you use price to book, price to earnings, price to sales. It's just that the Acquires Multiple has been to date the best. It's conceivable that there'll be some. It's sort of become a little bit voguish now. So it's conceivable that its utility might diminish a little bit over the very short term. But I think that it is a very good metric because it does penetrate all the way to through the financial statements to give you a pretty good idea about what you're paying for, which is the enterprise value, and what you're getting in return, which is the operating income. And that's the operating income is sort of sits above EBIT and EBITDA, and it looks at it's kind of looking through the capital structure. So earnings is sort of subject to how much tax the company pays, how much interest it pays, which sort of interest is tax deductible, so that impacts the tax. And depreciation and amortization are often backed out because they're non-cash charges. Even though they're real economic charges, they're just non-cash to the company in any given year.
Mm-hmm. Yeah, and another thing is that I think we all read this disclaimer saying past results or past returns, they're not a guarantee of the future. But then again, to me, I guess it makes a lot of sense that this deep value approach or across multiple approach would still outperform. I would actually like to hear your thoughts about that.
It's one of those great kind of philosophical, metaphysical questions. Will something that has predicted returns in the past continue to work in the future? Will value investing itself continue to work? I think the concept of value investing, that you're buying something for less than it's worth, and therefore it doesn't really matter if the price necessarily reflects the underlying value that you've purchased. Ever. You can buy a very undervalued company and just keep on holding it and investing in it. It can remain undervalued the entire time that you hold it, and you can still do very well provided that it's compounding and you're getting some sort of economic interest out of it. All that something like the acquirer's multiple is a proxy for an estimate of intrinsic value, proxy or an estimate of intrinsic value. So there are different ways of doing it. Buffett favors the return on invested capital type metric. So he would say that something that's earning, so if you have one business that's earning 5% on assets and another business that's earning 20% on assets, all else being equal, the 20% business is worth 4 times the 5% business. And if our alternative is kind of the 10-year treasury and it's earning 5% on assets, then maybe adjusting for the risk of the two, then other things being equal, all earnings being paid out, the 20% business is worth 4 times its invested capital, because the alternative is the risk-free 10-year or 20-year paying out 5%. So that's the best model, really. That's the kind of the ideal model to use. The problem is it's very difficult to apply, because businesses that earn 20% on earnings tend to be they tend to attract competition, because it's kind of super normal earnings. You can invest $1, get back 20 cents, where everywhere else you've got to invest $1 to get back 5 cents, and that kind of pushes the return down.
Yeah, and sorry, Toby, I didn't mean to interrupt.
I was just going to. The point that I was going to make is that the acquirer's multiple, it doesn't do that kind of analysis. It's merely looking at what you're paying and what you're getting out, and it would seem that removing that sort of additional bit of information about what the internal earnings of the business on its assets are would reduce the performance of it, but it doesn't, for the reason that there are these microeconomic forces at work pushing down the returns on invested capital.
Yeah, because I guess that would kind of be my next question, and something I also thought a lot about. And I know it's the same idea that Greenblatt also had, because if we could model Warren Buffett's favorite companies, and you were talking about that before, you would be looking at companies that have a high return on invested capital. Some people would look at return on assets, return on ROE, which is more or less the same thing. But I was curious, with your back testing and all the data sets you have you figured out that if there was some way to predict or model the companies that will not lose this competitive advantage, like Coca-Cola, for instance, in the past?
The person who's done the best research on that is Michael Mauboussin. And he's kind of approached it scientifically in a quantitative sense. He's looked at all of the possibilities. So I think he he took he's basically devolved the return on equity into its various components, asset turnover and profit margin, and he's found that profit margin is more useful in finding companies that can actually withstand competition than asset turnover. So high asset turnover is not a great metric. The problem is that, and he looks at this kind of on a rolling 10-year basis, and he's been doing it for at least 10 years. So he'll look at a company that has the highest returns on equity, and he can rank 1,000 companies on their returns on equity, and he can take a quintile, which is the top 20%, and he can look at the bottom 20% and everyone in between, and he can see how their returns on equity progress over time. And he finds in most instances the high return on equity companies tend to regress to the median or the mean, and the low return on equity companies tend to rise to the median or the mean. In that group, though, there is a small proportion in the high return on equity companies. There is a small proportion that manage to maintain their returns through the entire period, but he's not able to explain why they do that beyond randomness. You would expect that there would be some that just through luck remain in the top cohort. It does seem that there are a very small percentage, maybe 4%, that do have this sort of sustainable return on equity, and they are the kind of ones that you've identified: Coca-Cola, P&G, but everybody knows what they are, so they tend to be very expensive most of the time.
Yeah, and I think that's a really good point, and I think that from my point of view, I've been looking at those 20% plus that Warren Buffett, especially in the past, have been able to prove, and I just think it's too hard, and also I think you also need a very specific skill set to find companies that can do that. So, I mean, I don't know if I'm just lazy, but I had this idea that, if I can do, I think you're proving something like 15% on the acquired multiple, and I can get that from a calculator. I was like, this is a great deal for someone as lazy as me. But I don't know, do you think it's ever possible to model like the next great stock pick, the next economic franchise Warren Buffett kind of stock pick? Do you think that's ever possible?
I think that it is possible, and I think that there's a lot of people trying to do it. I just don't think that anybody's done it yet. And it's one of those things that if they can do it, and you can identify the kind of companies that do sustain those high returns on invested capital, does it then become something that's immediately arbitraged away and reflected in the price? Because if you know that they are going to be able to compound at high rates of growth. So one of the examples that I always give is what was an excessive multiple to pay for Walmart if you could have identified it back when it listed in the 70s? What was too much? And I think if you paid 1,000 times for Walmart's earnings, you still would have got like a 12% compound return to date. So that's the reason that these are very attractive companies, because if they can compound at high rates, they can grow massively, and the compounding sort of 20, 30 years down the road is at such a huge proportion relative to your early investment that they make very good investments.
Wow. Really, really good answer. I'm really happy that we record this video, because usually I would, anyone knows me, I will always sit and type something down whenever I listen to smart people like you. And I know that you're a really smart person, because in your book, Quantitative Value, you examine how we can eliminate earnings manipulation, fraud, and financial distress. And as for me as a security analyst, and this is just my own small portfolio, this is always something that I try to detect myself. But it appears to me that you have come up with a better approach.
I think if management is set on conducting fraud, and the financial statements are pure fiction, but they're sufficiently adept with accounting rules, then it's very, very hard to detect. But there are these sort of statistical measures that point towards these things, and what is most interesting is that they all tend to occur at the same time. So earnings manipulation is kind of the gateway drug to outright fraud, and you tend to find earnings manipulation and fraud with financial distress. Companies that are doing really well don't tend to engage in, they don't need to manipulate their financial statements because they're doing really well. They just want to tell everybody what's actually happening. It's when they're doing badly and they're trying to stave off creditors that the financial statements become a work of fiction. So there's a suite of these metrics that we can use, and they're basically often what they've done is they've, in each of these different models that we outline in quantitative value, what the researchers have done is go and find a cohort of either failed companies or companies where the earnings manipulation has been detected, and then they examine all of the indicia that can be detected in their financial statements, and then they just basically conduct a regression analysis of that, and that's why they get these coefficients that are kind of, you'll see some coefficients out to 3 decimal places, and it's looking at one thing in relation to another. The things that I think are really powerful that almost supersede those types of analysis, what you really want is the cash flow that's flowing into the business to match the accounting earnings. It's never going to do it precisely because sometimes they're building inventories, sometimes they're running inventories down. Lots of other things are occurring that change cash flow and accounting earnings, but over a long enough period of time, 5 years or 3 years or 7 years, something like that, the two should basically match each other. So I think that's the most powerful. So you're looking for accruals, and we've got various different measures looking for accruals, and we've got various different measures looking for unusual things. So one thing that the Australian investor, Bronte Capital, John Hampton, talks about, because he's a pretty well-known short seller. So one thing that he looks for is one of these unusual assets that starts expanding. So the way that you hide something that's not there is you create this offsetting asset. So the earnings are never coming in, but you create this offsetting asset, and then at some stage down the road, that offsetting asset just disappears. And the example he gives is of Parmalat. They said that they'd had like $1 billion stolen from some unusual bank account that was not related to the head, that was nowhere near the head company. This is sort of all before the fraud came out. But he says that you could have detected that beforehand by looking at that asset blowing up totally disproportionate to everything else on the balance sheet.
Well, and I think this is really good rule of thumb. So you would be saying, it's really hard to manipulate cash, and if cash turns up in your bank account, it's just in general really hard to do compared to like accounts receivables. Like we can always sell on credit, but will we ever receive the money? So I think that's I know a rule of thumb that I will definitely remember from this interview.
Unless they're just dead set on completely lying about the existence of that asset, which seems to have been the case in Parmalat. So you really needed to look at that gigantic asset there and say, does that really exist? Why are they doing it that way? Mm-hmm. So that's one of the other things that I like to do, is to look at short interest, because I think that short sellers tend to be the smartest guys on the block. They do more research than anybody else because everything's running against them. The company wants the stock to go up. The investors want the stock to go up. The Federal Reserve wants the stock to go up. Everybody wants the stock market to go up. So when these guys find ones, they really have to know their stuff. But the funny story that I always have is I was long St. Joe's, which was which exists now. It's a timber company in Florida. And I was sitting beside a blogger who had previously been long this particular company, and Einhorn, David Einhorn, had a short on it years and years ago in the early 2000s at sort of $80. And John, who likes sort of undervalued assets, had contacted him and said, do you really think this is a short? Because I think this is a long. I think it's good value. Einhorn, of course, is right. That's why he's David Einhorn, because he does enormous amounts of research on these things.
He's really smart, yeah.
And I think it had crashed. It had kind of crashed, like bottomed at $12, and it had recovered to kind of 27 or something like that.
Wow.
And I had bought it at about 20. And at 27, I thought, it was doing okay. And I was sitting beside John, and all you get at one of these conferences, it was the Value Investing Congress in New York a few years ago, all you get is the title of the talk. You don't know what the stock is that's going to be discussed. And the title was, "If They Build It, they won't come. And I turned to John and I just had this sick feeling in my stomach that it was about St. Joe's. And I said he wouldn't short this again at 27, would he? Because it's cruel and unusual at this level. You know, he's already made close to 4 times on his money and presumably sold at the bottom. John was like, I don't know. And of course then he came out and he talked about St. Joe's and the stock. In the course of him talking, the stock crashed to sort of $17 or something, like in the 15 minutes that he started talking. But the thing is that when I saw his presentation, it was 120 slides long. He'd driven the streets, and you know, I kind of had to give him that the research was better than the research that I had conducted in it, and it was hard to argue that he was wrong. So I think that's kind of a pretty good vignette of why the short sellers are smart. And I look at short interest ratio when I'm constructing my models, and I include that as part of the fraud, earnings manipulation, and financial distress metrics, because I think if really high short interest tends to be an indication that there is something else going on. It doesn't necessarily mean that you want to short those stocks, because it's very hard to get the borrow. It's very, very hard to make money as a short seller, but it's something that you might want to avoid if you're a long guy.
Yeah, so how do you apply that in your acquires multiple side, or as an investor? Is it like you will have a huge pile or huge bunch of stocks, and then you will screen them and find the best one, and then you're not done because you also need to exclude some of those stocks because they might be subject to earnings manipulation, fraud, so on? Is that the process?
So we start with the universe of depending on which particular universe we're looking at. But on the site we've got 3 screeners. One is just a large cap top 1,000 that we give away for free, and then I've got 2 others that basically divide the universe into 2. One is what I call the all investable, and that's the largest 50%. It might surprise people to know that the smallest company in the largest 50% is $130 million market cap. So that's quite small.
Yeah.
That's not really investable for sort of most funds. Like an investable number would be 250 million, something like that. But for most investors, that's going to be perfectly fine. And then there's a small and micro cap universe, which is the smallest 50%. So, I think the median market capitalization is something like $24 million or something. It's very small. So there are a lot of really small companies in that universe. But in each instance, the first step that I run is to eliminate any of those sort of fraud, earnings manipulators, potential frauds, potential earnings manipulators, high short interest, potential financial distress. The reason is that those things can't ever have an intrinsic value, so there can be no sort of margin of safety there, which is as a value investor, that's the first thing that you're looking for, because it protects you on the downside, and it describes for you how big your upside potentially is.
Okay, I think that was a really good answer, and it so happens it leads me to the very next one, because I just said I struggle so much with figuring out what's the right stock and which stock should I exclude. As everybody else, I guess I use a stock screener to get like a general overview of which stocks to look at. Now, I gotta admit, Toby, that before we actually made the first interview on the Investors Podcast, I looked up your site, Acquires Multiple, and I tried out the free screener because I'm very cheap. So
that's fine. That's why it's there.
Yeah. So and that was really that was great, a great experience. So now I'm thinking I should use this strategy because I've read Deep Value. I tried your stock screener. I even read Quantitative Value, which is again 2 fantastic books. And so I'm thinking I should do the same thing because you kind of outline exactly what you do. Like it's really no secret. It's one of the last pages on Quantitative Value. You actually list up, so this is what I do, this is the first step, this is the companies I'm looking at, and so on and so on. So that's extremely valuable. So I was almost ready to apply at least some of my funds into a similar strategy. But then, something dawned to me, and that was that I need to buy 20 to 30 stocks, and that's a lot of transaction cost. Partly because I need to pay a lot of commission to my broker. Like I might be paying like $10 for a trade, and I also have to sell them again. So that's easily like 40 trades, $400. So first of all, you need to have a decent sized portfolio to do that. That's one thing. And the other thing is that you need to rebalance. So I think you suggest you should do it after a year and 1 day. But basically, you need to, like, there's a lot of manual labor involved, if you can even say that about stock investing. So my question to you would be, how do I do it, like, the easiest way? And what comes to my mind is something like an ETF with a low expense ratio, and it would just sit in my broker's account. That's just it.
Well, that's exactly right. They are. If you love investing and you want to spend some time every month or every quarter, I suggest rebalancing kind of quarterly, but tax drag is enormous. You have to be aware that you don't want to sell short-term capital gains to the extent that things are getting taken over all the time. That's the purpose of the screener, to identify things that are going to attract some activist attention or get taken over. So they're frequently kind of paying out special dividends or doing buybacks or tendering. All of these sort of things are going on. So, but also there are other things in the screen that are trying to identify companies that even though they might appear in the screen, they might, things deteriorate over a quarter and they're no longer as attractive as they were, and so you can rebalance out over a month or a quarter, and so you're hoping that your sort of short-term losses are rubbing out some of your short-term gains, and all of your big gains are long-term capital gains. So it makes sense to do it on a quarterly basis, or to examine it on a quarterly basis, not to necessarily trade. But that isn't and I can tell you, managing the accounts, it's a lot of work. And I have a lot of automation in the background in my system. It's still a lot of work, and they're kind of difficult to trade, all those sort of things. So the solution is certainly an ETF for most investors. I get an inquiry every day or so asking whether we'll have one. It's on its way. It's a very long, expensive process, but it is on its way, and in various different flavors. So international and domestic.
Wow. Fantastic. I actually didn't know that. So if people are thinking, hey, so Stig is in the same mastermind group as Toby, he all knows all these things, I actually didn't know. So I'm thrilled about this. Like, you're really talking about an ETF, even though it's a long way down the road.
ETFs are absolutely going to be the way of the future for not passive investing, but sort of investing in these sort of models. So the advantage that they have over the old mutual fund model is that you don't pay any capital gains until you sell your own shares. So if you buy now, you just hold them for the next 20 years, you don't pay any CGT until you sell. The problem with the mutual fund, if it's been there for 25 years and the early guys bought some stocks, they bought Apple in 2002 and it's ridden up tenfold or 100-fold or whatever it's up in the interim. If they then sell that, you'll be paid out your proportionate share of the capital gains, not on the length of time that you've held, but as a proportion of the mutual fund. And so that's why it's not an attractive vehicle, because you're getting these capital gains tax flowed out to you all the time. So the ETF is a much better version. The thing is that most investors think of ETFs as kind of thematic or indexes, but there's no reason why you can't wrap a sort of any kind of active strategy, but the less discretion you have in it, the more quantitative it is, the more likely it is to perform the way that people expect it to perform, the more likely you're able to sort of assess the way that it will perform in the future. And that's why it's perfectly suited to the sort of strategy that I have, which is very systematic, looking for undervalued stocks, trying to do it on a kind of equal weight basis, and managing. We will sort of do all of the trading and all of the managing in the background, and all you've got to do is, it's one decision, buy it and hold it.
Yeah, and I've been doing some research whenever I heard about the Acquirers Multiple, because it's public information. I mean, you are very open about what you're doing. So I was thinking, someone else must have done something very similar. And to be honest, it was really hard for me to find. I think the closest I came, that was probably Wes, which
Yeah.
you accidentally know because you you
He's the
wrote.
co-author of Quantitative Value.
Yes, that was probably the closest one I got. But when I was looking into smart beta funds, which is probably the sort that is closest to what you're also thinking about, I read some descriptions saying like, well, we kind of look at companies with a low price to book, or it would say we also sometimes include price to earnings. I mean, what I really like about the thing that you do, and I want this to come out as unbiased as possible, is that you are very open about what you do. Just like Warren Buffett, he's very open about what he's doing, and still no one's copies, which is strange.
There are very strong institutional and behavioral reasons why people don't invest this way. And the institutional ones are pretty simply that we're going to charge a really low fee, and it just eats a business that they can charge quite high fees in. And so they're reluctant, I think, at this stage. A lot of these guys are reluctant to cannibalize that business. I think if I was in that position, you got to cannibalize your own business because somebody else is going to do it for you. I think in 10 years' time, there's going to be all of the money will have flowed from mutual funds, or a lot of money will have flowed from mutual funds into ETFs. So if I was them, I'd be cannibalizing my business rather than letting somebody else do it for you. But there are very powerful institutional reasons why they don't. They have sales teams set up. In an ETF, there's no way of compensating somebody who makes a sale other than through brokerage, and you can pay basis points for brokerage. Now, the operator of the ETF has no idea who's sort of bought or sold the shares, so there's no way of paying commissions outside of that process. So that's one reason. On the investment side, the behavioral reasons are quite powerful. We've sort of been schooled that passive indexes are the best way to invest. And I think that everybody's kind of now come to the realization that there is a serious problem with passive indexes, and that is that when something gets very expensive, it becomes an increasingly larger portion of the index. When all else being equal, you want to be kind of invested in the less expensive portion of the index and hold less of the really expensive stuff. So the answer to that has been these fundamental indexes. So Research Affiliates, who's based out in Newport in California, sort of close-ish to me, they have the Research Affiliates Fundamental Index. And so they look at fundamental measures like book to market, price to book, I think sales. They might look at the number of employees. So they're looking at trying to sort of scale rather than on market capitalization, trying to scale on fundamental measures like that. The problem that you have, and this is something that I encountered when I had a baby a few months ago, and Mum and Dad came and visited, and I was looking at Dad's portfolio, and I saw he's 50% financials. I said, why are you 50% financials? And that's what his broker had put him into. And then I said, you've got to move into an index. Let's not put you in the normal kind of index. Let's find a value index. And the Research Affiliates has an Australian, my parents are I'm Australian, has this Australian index. And I looked at the index, and the index is 50% financials.
Wow.
And then why is that? That's because the Australian index is 50% financials on a market capitalization and on a fundamental basis. So, no financial advisor would look at a portfolio and say, you need 50% financials if they were going to construct it. They'd try and they'd scale that way down.
Yeah.
And so I think that the better way of doing it is to sort of say, well, what we're going to do is we're not going to buy every stock. We're going to buy the ones that are undervalued. We're going to try and do it in a systematic way. We're going to use a metric or a series of metrics that we know that identify undervalued stocks. They've done so historically. Yes, there are going to be periods where we underperform. If the market goes down, we're going to go down with the market. And we're going to have little bumps and losses along the way. But over the very long term, over 3 years, 5 years, 7 years, 10 years, you're going to be much better served being in an undervalued, in a value portfolio than you are in the index.
Yeah. So I don't know how much you can speak about this ETF, but you might also just want to share your general thoughts. Because I was thinking, yes, we definitely want to admit being 50% exposed to financials, But are you talking about an active managed ETF, which we to some extent don't want because there's always like human bias, or are you talking about very strict rules like I will always buy the cheapest ones, but I will only have 3 in financials or 15% in financials, or however you want to construct that rule?
That's the problem with active investment when it's done in a discretionary way. So you have some superstar manager there who is a very good investor probably and is able to kind of identify the undervalued things, and concentrate into them and hold them regardless of what happens. The problem with that is that everybody is sort of subject to behavioural errors. Some guys favour particular sectors over others because they feel more comfortable in those sectors. And then you have some sort of occasional, they might lose their touch. Lots of things can occur. People get old, they sort of lose a step. What's one of the nice things about the quantitative, systematic, methodical way of doing it, that the system isn't really going, if the market's down 60, 70%, most managers, if they're human, are going to feel that, and that's a shock to the system. The methodical quantitative system won't care. It'll just keep on doing what it does, and really that's the time that you want to be kind of paying attention and investing, because the market will recover eventually, and it's those moves that you make at the bottom that sort of really help you subsequently as you recover. The problem, and this is a question that you have when you're designing the model, do you concentrate into sectors or do you not? So I favour just letting the model do what it does, letting it select what it wants to select. And what that will mean is that you concentrate into sectors where they're undervalued. And it's just what happens when oil and gas gets a bump. Oil and gas stocks get cheap as a group. And if your mandate is to only put some portion of the portfolio into those stocks, and you think about the reasons why that might be, they want you to appear more like the index, because that's the metric against which you're being, that's the measuring stick. But that's an arbitrary kind of thing as well. It's the collection of stocks that happen to be on the stock market at the time. It's the size of those stocks. So yes, you're going to concentrate into sectors, and that creates volatility, because if you're in oil and gas, you're likely invested in oil and gas too early and you're being beaten up right now, or you're in minerals too early or something. That just happens. But high volatility, high tracking error are sort of symptoms of outperformance down the road. Yeah.
And I don't know how much you can tell about this ETF, because you also said it's a long time from now. Are we talking about 6 months or 18 months? Like what's the plan?
It's hard to say. Hopefully less than 18 months, but likely more than 6 months.
Okay. Okay.
Split the difference 12 months.
Something like a year from now.
It does depend a little bit on market conditions, so it's hard to get. It's just a fact of life that it's hard to get things away when the market's crashing, because people don't want to invest in them at that stage.
Yeah.
You've got lots of various parties interested, and even though I personally would think that would be the better time to go, I'm just one sort of voice in a big group who determine when things get going.
Yeah. And this might be a completely unreasonable question. That's Toby. Sorry, that's just me. I'm shameless.
Ask the hard questions, Stick.
Have you talked about an expense ratio? Is that something like? Do you have something in mind? Like, this is my target because this is what I would invest in myself if I was an investor.
It would be well below 1%. It would probably be likely. We're not entirely sure yet, but it'll be like 50 basis points, which is 0.5%, to sort of 75 basis points, which is 0.75%, somewhere in that sort of zone. I think that there's a huge amount of pressure on fees of ETFs to come down. Mm-hmm. So I think that 69, there are a lot that are out there at the moment that are about 69 basis points, which, that's pretty cheap relative to actively managed accounts, various other things that are out there. But it's going to come down. So it's hard to say. It's a little bit of a moving target, but it's sort of in that vicinity somewhere.
Okay. And I'm actually really happy you said that, because that means I can still say to my audience that hey, take a look at Toby's ETF, because when I'm asked, I always say less than 1%. I would never invest in something myself with more than 1%. And, that might be the most brilliant people, but I'm not comfortable about a company that has a, how should I really define it and not offend anyone? Like
a high-ish fee.
Yeah, because they have a structure, or they would typically have salespeople, as you were talking about before. Like, and I don't want to invest in such a company, so I always say less than 1%. And I really don't want to say anything bad about Greenblatt, but I get this question a lot. Like, would you invest in Greenblatt yourself? And like, I think you proved in your books that your multiple can do better. But I also think that what I have found with him was the cost was 2.25. And there's a huge difference between 2.25 and to 0.75. And also, you need a minimum of $250,000, which is, for most people, completely...
It's too much, yeah.
It's too much. And even if you had, like, $1 million, well, perhaps you're still not diversified enough. Like, you want to have, like, 10 different stocks or 10 different instruments. So, yeah.
You want to charge as much as you possibly can. Like, as a manager, that's just
Sure.
You're running a business. You're trying to charge as much as you possibly can. I've also got this sort of competing urge, and I think a lot of other guys who are managers have this too. I really want a fantastic long-term track record. Like, I want in 20 or 25 years' time, I'll only be sort of 55, 60 then, which is still young. In the investment universe, you can go well beyond that. But that's kind of a long-term track record, 20 or 25 years. If you compound the fee over that period of time, it becomes a very big number. And so it's also a vanity to kind of keep it a little bit lower, so that I really want to show that the model can do something extraordinary over that period of time. And one of the ways to do that is to keep the fees low.
Yeah. Yeah, and I think you're right. I mean, this is the way that things are going. I mean, I think the time where you can start a new fund and say, well, that's 2 or 3%, I think that would definitely be less and less, and you will see much more people going into ETFs and similar instruments.
And that likely understates what it is too, because what's written on the wrapper is, it's missing the sales load and the commissions and other things like that you charge. ETFs are really going to be I think they're going to be the asset class of the future, because you can pay $9, whatever your brokerage fee is, to invest almost as much as you want through your online broker, and then a very low expense ratio, run in a systematic way based on solid research. I think that's a very compelling offering. The way that we're going to have to communicate to people will be different to the way that it's been done traditionally. So they would sell through sales groups, and I'm going to have to. We're going to try and do it in a more direct fashion. So we'll be doing lots of podcasts and doing lots of blogging.
I'm so happy you said that, because I was
writing books.
Yeah, what would be your distribution channel? I'm thinking, hey, I got Toby's phone number.
if only we had some way of identifying all of the sales that you made stick. We could direct some, but we just don't.
Well, I can definitely promise to everyone out there that we will definitely bring on Toby, both for the next time he launches a book or ETF, both on the video series, but also on the podcast. And I really don't want to sound like I'm rounding off the interview, because I'm really not, but I just want to put it there. If anyone was thinking, that sounds interesting, I hope that I will figure it out in like 12 months from now.
I hope it's less than 12 months from now, but I hope it's not longer than that.
Okay, because I'm thinking, and I'm sure a lot of other people are thinking, this sounds like a really good strategy. Like we all heard Warren Buffett or any other great investor saying, well, you can just invest in the markets, set aside some money every month, and by the time you are like 20 years from now, you would be well off. Now, my question would be, if I did this strategy myself, I would buying 20 to 30 stocks according to the Quartz principle. Now, I would be somewhat confident about that. I don't know if I'll put like 100% of my portfolio using that strategy, but definitely a very significant part. And I think a lot of the audience feel the same way. But say that we will not do that. Say that we'll use the same strategy, but we will use an instrument, or we would use you, for instance, Toby, as a manager. And this is definitely not like directed at you, but we all know that when managers are involved, there can be fraud, there can be, all kind of things happening. So do you have any thoughts about how are funds and managers, regulated? Like, how can we assure that if we put all our money in a fund like this, it might perform bad because strategy is bad, but it will not, go bankrupt because someone just ran away?
There's an enormous amount of regulation around ETFs, and that's why the process is so slow to have them issued. As a manager, really all I do is, and particularly as a systematic quantitative manager, is to set the rules by which it will be traded, and then there are lots of other entities that sit behind that. There's a custodian. These are third-party entities that I have nothing to do with, custodians and operators, and all of the funds are held at that level. So it would be, I don't have any access whatsoever, and I run I have managed accounts as well, and I run them the same way. I have the broker custodian custodies the assets, so I have no access to the assets. I have a very limited power of attorney to trade them, and if the person who is invested with me in the managed accounts gets unhappy, they can turn that off tomorrow if they want to. They can completely remove my access to it because I have what's called I have a manager's access to it, and they have the portfolio is custodied with them. ETFs are a much more complicated version of that, where there are many layers. So there's always risk, I think, that there's some bad actor in there. I think it's fairly minimised if you get the best custodians and advisors and sub-advisors and the various other bits and pieces. But that's a good reason why. That's the reason why you diversify into 3 or 5 sort of different managers. So just in case there is anything untoward, I think it would be very difficult to sort of conduct fraud in there. I know I'm kind of talking my book when I'm saying that, but if there's a way to do it, I haven't figured it out.
Okay. Yeah. I think that's reasonable. Just to make it completely clear that if you were using the exact same strategy as Preston and Harry, for instance, people that don't know that, also some of my friends on the podcast, and using the exact same strategy, same calculator, same system, but some of you wanted to cheat the system. You wanted to run away with the money. You would say that's completely impossible, or close to being completely impossible.
There's no way to transfer the assets out of the account and to disappear to an island somewhere. That's impossible. There are lots of things that the way that they used to do it in the past was, brokers used to front run the trades. So I know that a big client's going to buy shares in IBM, so I go and buy a whole lot of IBM, and then I put that client through, and it pushes up the price. So that you can always go and do that sort of thing. So you could trade against the account. So you could find some really illiquid stocks, and you can get set at a lower price, and then cause the fund or the account to come in and buy your own positions out at a much higher price. And so that would be, that would still be possible. That's completely illegal, not to mention unethical and all this. And
Sure.
you'd be thrown in jail for doing that. But you always have to have some trust in the guy who's managing, that he's not just trying to steal from you. I always think Charlie Munger has the best line about that, when he says if people realised how much money there was in acting ethically, they'd never go and behave in these other ways. And that's over a really long career. Like, that's the thing that amazed me most about Madoff, is that Madoff built this enormous organisation. And he was a very well-respected guy. He'd been committing fraud the entire way through. But if he'd applied those same talents to kind of acting in a, lawful, ethical, legal manner, he'd have been sort of comparably successful. That's why it's just mind-boggling that they go and behave in these sort of fraudulent ways,
Yeah, I think you're definitely right. And another thing is, I don't get that you can, cheat so many people so much money without, it's only being one person. I think a lot of people think he is the only one involved. He's just the bad guy. But just to pull off a stunt like that, you need to involve a lot of people. It would not just be Stig running off to Bahamas, or it's much more complicated than that. That's definitely a side note. There's just something that just came to my mind.
I think most people would be caught eventually. The amazing thing is that it went on for so long. And I've spoken to so many, we've read, there was the Harry Markopoulos, I think his name was, who had identified that there was definitely something going on. I don't think he knew what it was. And Ed Thorpe, whose features in Quantitative Value and a book that I'm working on now, Concentrated Investing, he was a mathematician who he wrote the book Beat the Dealer, and then he wrote Beat the Market, and he set up the first convertible arbitrage fund called Princeton Newport Associates, which I think became Ridgeline or something like that, something later on. Somebody, after he'd sort of retired from the first version of those funds, someone asked him to look at Madoff's trade, who was considering an investment, and he just looked at the number of shares or options that he said he'd bought on a particular day, and Thorpe was like, well, that's more options than there are in the market. Fewer options than that traded on the market in that day, so it's impossible that he did that sort of volume on that day. And that would have been a pretty simple analysis, I would have thought, for most. Every single person who I've spoken to who had some dealing in that part of the market sort of seemed to think that there was something odd going on there, because they just were doing too much business relative to the actual business that was going on in the market.
Yeah, and I'm so happy that you mentioned Thorpe, because he is an amazing guy. I think that, I know it's hard to compare, but he's probably one of the brightest guys out there. And I would really recommend anyone to look out some of his work. He's an amazing character. I mean, it's not just that he's a great investor. I mean, as a character, he's just extremely unique.
Thorpe is fascinating. But one of the stories that I have in concentrated investing, or concentration investing, is that I really like. So Mohnish Pabrai he's a value investor out here and based in Santa Monica. He's well known for a lot of things, but one of them is he bid at auction and won the Glide auction to have lunch with Warren Buffett, which he did with Guy Spear a few years ago. He's a great investor and he's a super smart guy. He's written a fantastic book called The Dhando Investor, which is well worth reading if you haven't read that. And he talks about the application of Kelly theory, which is the bet sizing. So Kelly theory is the optimal bet size that you put on when you have any kind of insight into a bet that you might take. So if you have an edge, but you don't know how much to put in, Kelly basically gives you this calculation, which is edge over odds over edge, and it tells you how much of your bankroll or your portfolio you can invest in any given position. So he does this Pabrai does this analysis in the Dhando Investor, where he says he gives an estimate for the outcomes of this particular investment. It was sort of 80% that it would go up, 100%, 19% that it would stay where it was, and 1% that it would be a zero. And he says when you put that into Kelly, it recommends something like 95% of your portfolio in a position like that, which is an enormous bet. And he says he didn't do it at the time because he'd never heard of it.
Yeah.
But Thorpe comes along, who sort of was the first person to apply Kelly theory, and he says there's a problem with that analysis, and that it is that it ignores other bets that you could take at the same time. And he says if you include all these other bets, these other opportunity costs, it sizes down the position a huge amount, and it might size it down to sort of 10 or 5% of a portfolio, which is interesting because it sort of coincides with all of the other research on portfolio sizing.
Yeah, and I don't know if you would like me to compare you with Thorpe.
I would not,
because I think that
it would be unfavorable.
That would be unfair. But what I think that you would do, or let me just put it all about, what I think is amazing that Thorpe would do was that he is very academic to some extent. I mean, he knows all that
Very
stuff.
much so.
He knows he knows how to back test, and he knows. I think he even came up with back scores before back scores, just on warrants instead of options.
He was just using it to make money.
Yeah, he was just using it to make money. He didn't want any Nobel Prize or anything for that. But I think he also had the other side, which is this, practicality and how to be, in lack of better words, I would probably say street smart. Because this is a guy who was sitting at a casino in Las Vegas, and with his own mini computer, and he frightened to be beaten up by guards, and he can do both things. And I'm not saying that you're a gambler and you're sitting in Vegas or anything, Toby, but I also think that you have like the academic side. I think some of the books I read from you is probably more academic than a lot of the other investment books I read, but I also think you're very practical in your approach, and I think that also gives a lot of credibility.
That's very kind. I think the thing that makes thought fascinating is that it is exactly that. That he writes academic papers, and he thinks in that sort of realm, but every single one of those is practically applied by him, and that there's a huge chasm between sort of having an idea, having that sort of academic idea, identifying that phenomenon, and then applying it in the real world. It's almost the old 1% inspiration, 99% perspiration. It's really that much more difficult to do it in real life than it is to sort of just think about it. I'm not a finance academic at all. I should point out I'm a corporate advisory attorney who's been sort of investing since. But from my perspective, the sort of stuff that I was working on as a lawyer is in the same realm. I was doing mergers and acquisitions and capital raisings and activist defense mostly, because those were the clients that I had. And then I worked in an activist fund and did some activism. But I'm not an academic. I think that the reason I'm sort of attracted to the systematic quantitative stuff is I just know that I've made lots and lots of mistakes as an investor that I would not have made if I'd approached it in a more sort of systematic, scientific way.
Yeah, I completely get what you mean. I kind of feel like I have the knowledge to understand why deep value would work or value investing in general would work, but I don't have the capacity of talent as Warren Buffett to make like the specific stock pick. So I need to do something in between.
That's it.
Since I'm very lazy, I'll just need to invest in your ETF in a year and let you.
Please do so.
Okay, so I got to be completely honest with you, Toby. I've been amazed with the feedback that we've gotten whenever you are on the podcast. I think you've been on the podcast like 3 times. One was just
twice, I think.
Twice.
Is it 3 times? It's so much fun, Stig. I forget.
Oh yeah, we did one with you and 2 mastermind, but I think that your son was just born right before one of the mastermind groups, so you didn't make that one. I think that was right. The way it was.
He's not sleeping through the night, but he's giving me a little bit of sleep, so getting back to normal. Not for my wife, but it's getting back to normal for me.
Okay, that's good to know. So, but we have gotten a lot of feedback, and I think that I wouldn't say it's surprised because what you did really resonated with me too. But we had a lot of great guests on, and I think that easily I would have more questions about your material than at least the last 20 guests combined. I mean, it's amazing the amount of questions I'm getting, and sometimes I feel, hey, I can just forward that to to Toby, but I guess they also want my take. And what I actually did to the audience was to ask them. So I'm interviewing Toby real soon. Do you have any questions for him? And I got a lot of great questions, but I definitely want to ask you this question, and this is from Anna Simander from the forum, and he's using your stock screener at Acquires Multiple, and he has the following question. He's saying, when employing a mechanical strategy, what things can I check for without allowing cognitive bias to affect results? At the moment, I'm buying pretty much whatever the screen tells me, other than those companies that are suspended from trading or which are announced they're going private. So what would your response be to that question?
It's an excellent question. So you're asking the sort of, he's asking what additional analyses can he conduct on the stocks that the screener identifies to sort of find the ones that are better than the others. So yeah. Without sort of allowing the cognitive bias, and that's why it's a great question. So I always say that the prima facie position, the first thought that you have to have is that cherry picking from the screen will probably lead to underperformance, simply because you're going to go for the things that look the best, and it just tends to be that the things that look the worst outperform because everybody thinks the same way. They kind of go for the things that do better, and that's some research that that Greenblatt, when he was conducting his own studies, and he had an advisory firm that allowed people to automate their accounts or to do it sort of on a discretionary basis, and the automated accounts vastly outperformed the market, and the discretionary accounts, not only did they underperform the automatic accounts, they underperformed the market. So they actually took what was a winning strategy and cherry-picked out all of the performance to turn it into one that couldn't even beat the market. So it's a great question. What I tend to do is if I have an idea that might improve the performance of the screen, we're talking about back testing here, so there are lots of pitfalls with back testing, but I tend to go and test it. And it's incredibly difficult to find. It's easy enough to find something that will outperform a screen, so 50% of the time the thing might outperform. That doesn't necessarily mean that it will continue to do so in the future. Just by random chance you find things that lead to better performance. It is an incredibly difficult thing to do, simply because so you have to do it in a scientific way. That's the first thing, but it's difficult because there is just a lot of randomness in the screen. So the first step, I think, is always it has to be something that makes sense as an investor. That would be what I would suggest. So what things lead to, if you can identify a factor that leads, anytime a company has this particular thing, it tends to not perform very well, then that would be something that you could apply. So it's very difficult to think of an example that's not already in the model, because when I find something, I have tended to put them in. But that's also and this is the second part of the answer. I'm sorry, this is a confused answer, but the second part is you have to be very careful not to keep on changing the model. And the reason is that every single model goes through periods of outperformance and underperformance, and it's very tempting when you're underperforming to tweak the model to sort of eliminate that period of underperformance. And the problem is if you start doing that, you're always kind of fitting to the most recent period of performance. And what you really want to do is fit something sensible that works over the entire period. So that's why I'm a value guy, and that's why I take steps to eliminate the frauds and the earnings manipulators, because that makes sense to me. And then I look for these other criteria that sort of attract big funds, because I think that I assume that I don't know everything. And I assume that if these other guys are going to be attracted to this, then they're going to do some additional forensic research if they're going to take them private, and that's going to be valuable to me. So it's extremely difficult. The short answer is it's extremely difficult to find a way to outperform the screen. But you can do, your approach could be as a very concentrated guy. So one thing that Buffett suggests doing, which may help, it might not help you outperform the screen, but it might help you perform in a different way, is to look at a company and think, will this be around in 10 years' time? And will it be substantially bigger than it is now in 10 years' time? If the answer to that is yes, and you have some sort of skill and ability to make those sort of insights, make those observations, then that might be something that can help you. I personally don't think that I have those skills, so I lean very heavily on the mechanical model, and I tend to test and I put it in. So one of the things that we were going to discuss earlier is this investment and research and development loop. So one trap is that you always amending the model and including these new things in, and that impacts the way that you invest. So what I like to do is I think of them as two separate loops. So the investment loop, make an investment, observe how it performs, identify things that didn't work, take those things back into the research and development process and see if, and being sort of conservative and very skeptical, seeing if they can provide some additional performance in the model. It's kind of hard to do it outside of that loop. So I may be overstating it, but I think it is kind of difficult to do that externally. But then if you're a reasonably skillful investor and you've internalized security analysis and those other things, or you've internalized some other process, and you're seeing things in the screen that are leading to underperformance, by all means, apply those rules and let me know about it so I can put it into my system.
Great. Yeah, and I thought it was such an insightful question. I think you had a great answer to that, because how do you make your own analysis without making your own analysis? That was basically the question, right? And I guess that is what everyone wants to do with the deep value. Like, you want to omit like the cognitive bias, but at the same time, by applying some of your own knowledge, you can also beat the market by understanding the fundamentals about value investing. So
it's very hard to do, and it's not that the model's that great. It's just that any kind of systematic application of a sensible idea, I think, will do well over a long enough period of time, just because there's so many cognitive biases and behavioral errors and institutional type of problems with, so that the index investing, it's very voguish. Everybody observes that 80% of active managers underperform the index in any given year, and then you deduct from that their fees, and then you kind of get to the realization that you're much better off being in an index. But there are problems with investing in the index too. There's the one that I mentioned earlier, which is that you're sizing up into the bigger stuff that's likely to be more overvalued. But there's also, and Bloomberg had this article yesterday, that there are funds that, they announce 4 days beforehand what's going to be joining the index and what's going to leave, and the index funds can't buy it until the day that it joins the index. But any other investor, you don't need to be high frequency. You can be low frequency guy, take a few days to digest the information, and then go and buy that for your portfolio. And there is this bump in it. So that value must be taken out of the index fund. So the index itself won't register that loss, but there is that frictional cost to the index fund that is trying to track that underlying index, that they have done that. So there is a small frictional cost to the index fund over the index itself that's not accounted for. And there's some suggestion yesterday that it was sort of, if an index fund's charging 11 basis points, it might be kind of 23 additional basis points, which is still a very cheap way of investing. But then you have all of these other things going on in the index. So can a value guy trading against that index do better than that index? You would think so over a long enough period of time.
Yeah, so I'm curious about that. You're talking about 11 basis points, and I even see one with, I think the cheapest one I saw was like 7 basis points. Why is it that other ETFs and perhaps also yours, but other ETFs that is really, really passive and systemized, why are they charging more? I mean, where does that cost come from? Is that rebalancing or?
Well, it's not necessarily the fee that you charge. It depends a little bit on any kind of, it's a product being sold in a marketplace. Why does Netflix charge $8 a month? Mm-hmm. Why don't they charge $4 a month? They can probably sell it to you for that kind of money. Netflix probably wants to charge you $80 a month. And the answer is that you want to charge as much as you possibly can as a manager. Of course, a consumer of that product has a competing interest, which is to pay as little as possible. And I'm a consumer for most things, and I want to pay as little as possible. Mm. But the thing is, the return that you are going to get, the after-fee, after-tax return is the thing that you really care about. And so if you can get by eliminating... So Greenblatt, again, has written about this idea, but he talks about moving from a market capitalization weighted index to an equal weight index, removes that error of putting too much money into the bigger market capitalization companies just by equal weighting, and that gives you an additional 2% of performance per year. So then if you fundamental weight, which is what research affiliates do, that gives you another 2% of performance per year. And then Greenblatt says that by using the magic formula, you get an additional 2% or 4% of, I forget what it was, but he's shown pretty comprehensively that you do get that additional performance by doing that. So if Greenblatt charges 2.25% and his margin over the market capitalization weighted index is 6%, you're still better off being with Greenblatt. He could just about eat all of that margin and still provide a better service.
Yeah, you're definitely right. And I was completely blown away when I read that, just by using an equal weight, it was like 2%. I guess it kind of intuitively makes a lot of sense, but 2%, that's a lot. For something that is really not advanced. I know that we're talking about, across multiple or talking about simply priced earnings, but simply not by stock picking anything, but just equal weighting, you can get 2% performance. That was really surprising to me.
But there are no free lunches in investing. It does come along with these. There are trade-offs that you have to make, and the trade-off with equal weight investing is that you are going to have these periods of underperformance. So the equal weight index is now going to perform idiosyncratically relative to the market capitalization weighted index. So sometimes it'll be outperforming and sometimes it'll be underperforming, because 2% is not that much. It's going to be there or thereabouts. It's only over a very long period of time that little margin starts to show itself, and you have additional trading costs. So the nice thing about, if you put a portion of the fund into a market capitalization weighted company, as it expands relative to the other companies in the index, there's no need to do anything else with it because you've already got that money in the index. If you've got an equal weight index, now you've got to try and get back to equal weight. So it creates more trading, there's more friction, there's more tax. So that's the trade-off when you're doing those sort of things.
Yeah. Okay, so Toby, thank you so much for this interview. It has been so much fun and really interesting for me too. Now, I know how to get a hold on you. I'm really lucky about that. But what about like all other people? Like, where can they directly contact you, and where can they find out more about you?
All of the work that I'm currently doing is on Acquirers Multiple. So that's ACQUIRESMULTIPLE.com.
Yep, I'll make sure to put show notes and links to everything you say. So yeah,
and that's kind of the Acquirers Multiple stuff, and that's sort of where the focus is at the moment. There's also Greenbacked, which is the blog that I've had for years and years. I post on that when I find something that's interesting that's not necessarily directly related to Acquirers Multiple. I also have a research product with Jeff Gannon and Quan Wong called Singular Diligence, which is for guys who are very, once a month we produce a really long research report for guys who like to invest in those sort of companies. So those are the three best places, and the books are on Amazon, Deep Value and Quantitative Value, if anybody's interested.